Hello there and welcome to ADIPEC Energy Dialogues. This is a series of conversations brought to you in the run-up to ADIPEC 2020. I'm Etna Trainer, and every week we'll be talking to leading analysts and energy experts from around the world, sharing their news and views and bringing us up to date about what's impacting the market. I'm particularly happy this week to be joined with the president of the Rapidan Energy Group, Bob McNally. Thanks so much, Bob.
Great to be with you, Etna.
Now, Bob, a flotilla of ships is probably on its way to America at the moment, left Saudi Arabia when the oil price was cheap and they managed to get all of that oil on the high seas here. But a lot of people in the US may be not happy with that. But then we've had a recent announcement from Saudi Arabia that they're actually going to cut back more oil. So is it good news, bad news that's happening at the moment?
Right. Well, if you're the shale producers and Senator Cruz and other oil state senators, it's sort of bad news and then some good news. It's been head spinning, really, Etna, and you're a longtime observer as well. In April, the Saudis went to maximum production, up to 12 million barrels a day, when OPEC Plus sort of called it quits for a time. But then, and then during that time, a lot of their customers bought a lot of oil, and it was loaded on ships, and it's heading here. It's arriving, and it's being unloaded. Since then, over Easter weekend, OPEC Plus got back together again, as we know, and put in place cuts. But as we know, with the way leads and lags work in the oil market, that Saudi crude is now arriving, and it has captured the attention of politicians in Washington and the oil industry. And it's coinciding with the buildup of inventories in Cushing and other places. And so even though that oil was bought by US refiners and is going to be run by US refiners, the fact that it's arriving now is sort of unpleasant optics given the weakness in the oil sector and inventories rising.
So talk to me now, how will it impact the fact that Saudi Arabia has just said now that it's also going to cut back more than it was expected? That's a bit of
yeah, it's a great point. No, Saudi Arabia made a remarkable announcement. They said that they would unilaterally in June cut from 8.5 million barrels a day down to 7.5 million barrels a day. That is a swing from 12 to 7.5 million barrels a day in a couple months. I also understand UAE and Kuwait have chipped in some additional cuts as well. And Minister Abdulaziz told the press that this was an effort to be proactive and to lead by example and to encourage other OPEC Plus countries to implement their cuts as well. I think, Etna, this reflects two things. One, there's a sense that the cuts that were put in place over Easter weekend, 9.7 million barrels a day, probably weren't enough to accelerate the rebalancing as fast as folks wanted that to happen. There was also a hope that other G20 countries would contribute cuts, but those really haven't happened. Other than a little bit in Norway, we just saw Texas rejected a quota cut or putting in place mandatory cuts. So there needed to do some more work. Point number one. Point number two is the political problem that you just mentioned. I think the kingdom is eager to show, especially its allies in the United States, that it is leading in the solution to this problem.
Now, I mean, it would also like America to be doing something as well, though. And we look at, I think, maybe the disagreement among some of the commissioners in the Texas Railroad Commission. Some people calling for them to put those quotas in place to pro-rationing. That's the word I think I'm looking for. But they're not going to do it. That was rejected. You know, surely something needs to be done from the American side, or will it just naturally, reduction will just happen because the price is so low and they're going to stop production?
Yeah. Well, you know, ultimately, the kingdom and the other OPEC Plus producers decided to accept the Trump administration's argument and the industry's argument, which is the economically driven cuts will have to suffice. And, you know, after crude went negative there with the expiry of the May contract, we've seen an acceleration in shut-ins and a decline in completions in the United States. So shale oil, U.S. production has really hit the brakes starting this summer, much more so than people thought a couple months ago. So I guess if you're Saudi Arabia or UAE and you are hoping to see the Texas Railroad Commission to implement quotas, which now we call it prorationing, maybe you're disappointed. But on the other hand, U.S. production now has been slammed. I mean, we're going to end the year down 2.4 million barrels a day on an exit rate basis. The monthly declines are going to start hitting 300,000 to 500,000 barrels a day. The news, the rig laydowns, the shut-ins, looming bankruptcies. I mean, the U.S. oil industry has been damaged. It hasn't been because of policy-driven quotas, but it's been due to the economics and the oil price. So I think the damage is done, and what we see today is now the kingdom and other countries are willing to accelerate the rebalancing and the cleanup, recognizing the United States has probably given enough.
And of course, many people are also talking about, you know, that producing oil at this low price is actually considered economic waste. You just did a report, Rapidan did a report looking at the shale industry there. And again, when we look at the US, only last year been the biggest player in the world, really, and now the industry in such trouble. There's got to be some hope here, though, but in the short term, it's not looking likely, is it?
No, not in the near term. You know, we have seen well completions collapse by 80% from May to July. And we think even by the end of the year, they'll be down 50%. In order to get completions in the shale sector, we need to have WTI averaging $30 a barrel, and that price sticking or being perceived as sticking. And we don't see that until the end of the year. We'll have to redo our numbers like everybody else with these new cuts. But the May was just catastrophic in terms of oversupply. And it gets a little better in June. Rough estimate is even with these new cuts, we're still probably 1 to 2 million barrels a day oversupplied, but July will start to see deficit. We have Permian flat in the first quarter of 2020, and then falling by 700,000 barrels a day by July, down 1 million barrels a day. The Bakken play takes most of the cuts. It's got some of the higher costs, and it's further in terms of transportation from offtake areas, and so the hit to completion has even been bigger there. But no, it's going to take some time for the industry to recover from this. And again, to get those completions started, I think shale oil companies and producers are going to want to see 30-ish WTI come back and stick.
Now, talk to me about President Trump, forgive me. Talk to me about President Trump's view of OPEC Plus and really the swing producers here, and in terms of the management of the industry. That has shifted. How good or bad is that? You know,
a shift is one word, Etna. I would call it a remarkable metamorphosis. I mean, if you study President Trump, which many of us have had to do, and you look at his readings and his books over the decades, you find he's always been very interested in trade and very concerned about China. But also, he's also been very opposed to OPEC and the idea of a cartel influencing oil prices. This is a big theme for him. And he has been quite candid in recent weeks in admitting that his view about OPEC or OPEC Plus has shifted. Now that the U.S. had, under his watch, become the world's largest oil producer and a net oil exporter, something when I was in the Bush administration we didn't expect, I'll put it lightly. President Trump realizes that there's a downside to too low of oil prices. And he's admitted that, and that's why he sort of shifted from, let's say, arch foe of OPEC to best friend and even master of the deal. And I will venture to say, Etna, that had the kingdom not announced these cuts today, I bet you going up until the June 10 OPEC Plus meeting, there would have been more pressure from Washington to do more to help us accelerate. So now, you know, the extra work has been done. And President Trump, I think, is appreciating in a new way the importance of having swing production in the global oil market.
Yes, and I suppose it took him a bit of time actually to realize that, because there were some very strong words that used to be tweeted out, and he would make sure to time them perfectly for an OPEC meeting. How long do you think this friendship might last, though, and this great support? Because if it did last, I think it does wonders for the global oil market, really.
You know, I think as long as the danger is a bust too low of oil prices, oversupply, I think, you know, common interests will keep folks working together. And I think there will be an enduring appreciation in the United States and by President Trump of the work that OPEC plus producers, particularly the Gulf major producers, are doing in terms of voluntary cuts. So again, nothing like a price bust to focus producers' minds and increase appreciation for swing producers. Here's where my concern is, Etna, and this gets to the boom follows bust question. In my view, and I think history shows, where swing producers really struggle the most and ultimately fail is when prices boom, not when they bust. When demand is so strong that it's outstripping production and production capacity. The 4-decade reign of the Texas Railroad Commission ended in 1972 amidst a boom. And we saw in 2008 at almost $150 oil, with OPEC having put all its oil into the market, again, the swing producer sort of ran out of spare capacity in a boom, not a bust. So I think that's the challenge medium term is, will OPEC plus work together, and will the United States and other consuming countries, importing countries, appreciate OPEC plus in a boom cycle? And there I'm a little more cautious. In a bust, yes. In a boom, we'll see.
Let's come back to the state of play in terms of what's going on here and the impact of COVID-19. And we really look at it impacting the entire world. When we look on the economic side, we're also seeing a massive increase in sovereign debt, and also this situation with America and the US, and that seems to be getting worse by the day. Can you just bring me up to speed perhaps on both of those? But let's have a look at the increase in sovereign debt. How dangerous is that right now?
Right. You're right, Etna. I mean, there are so many ways in which the world is being reshaped by this. Some of them we don't even really understand yet, but there are at least two things, two consequential tectonic shifts that are taking place. One is the explosion in sovereign debt in the United States and around the world. A couple $1 trillion in the last few weeks, as the leader of the Senate noted, by voice vote with hardly any debate. We just increased the debt. The problem is the United States and other countries are increasing their debt from already high levels. And remember, that debt was going to explode anyway as the boomer generation retired. So on top of that already exploding debt, we are adding much more new debt, wartime levels of debt. You know, in the 2008 crisis, Etna, we were able to transfer bad private sector financial assets to the government balance sheet. We bailed out the banks. But now we're down to just the public balance sheet, and we're just issuing public debt. So we're at the end of the line, really. And I think this raises the question about inflation going forward. Inflation, which happens to be good for the oil industry or nominal oil prices. The need for taxes to pay back this debt, which is going to raise the issue of carbon and other kind of taxes down the road. But managing the debt is going to be an enormous problem, made even bigger by the pandemic crisis. It can also cause political realignments of ways that are startling to even think about. Managing that debt could bring the far left in the United States into power, or could lead to a more resurgent kind of a small government approach. So the debt is going to be an enormous problem. The second is US-China rivalry. If you step back, Etna, think about the 1950s, the United States and China fought big in Korea. In the 1960s, they'd ignored each other, except for a fight in Vietnam. In the 1970s, they approached each other because they were both interested in working against the Soviet Union. And then China began to open after Mao and Deng Xiaoping in the 1980s, and the United States became interested in China. In the 1990s, after the collapse of the Soviet Union, the United States and China, if we didn't fall in love, we coupled. We had high hopes. We believed that China realized socialism was failed, China was going to get rich, and then it was going to get democratic, and our businesses came together. But you know, I think the financial crisis of 2008 caused Beijing to look and say, America's not the model and capitalism's not the answer. And China's shifted to rivalry. Although we kept on, in the United States, I think, believing in a coupling and a productive relationship. But with President Trump now, the United States has joined, I think, China in perceiving our relationship as one of competition. Now, until the pandemic in January, both President Trump and President Xi were happy to park or suspend the competition. We had a phase one trade deal. President Trump wants to get reelected. He realized if you bang on China too much, the stock market goes down, the economy weakens, and you lose the election. So he wanted to park it until his second term. But the pandemic came along, and now it's going to be very difficult for President Trump and President Xi to control the escalation across several areas. Not only the phase one trade deal, China's unable to buy everything it was supposed to, including energy. Part of that is unavoidably driven by the pandemic. China is going to be blamed for, at the very least, allowing this virus to escape and not being transparent about it in the very beginning, making the damage worse. Hong Kong is going to be an issue. The United States has to decide whether it's going to continue granting Hong Kong free trade status. Taiwan, they're about to inaugurate for the second time the president of Taiwan, who's sort of anti-China, and there are increasing incidents and harassment and provocations in the South China Sea. And then there's the whole issue of technology transfer. And so the risk here, Etna, is the COVID crisis has sort of exploded the truce that China and the United States called in January, and may lead to intensified rivalry and escalation. What does this mean for oil and energy? A couple things. One, macroeconomically, it's not positive. It increases the risks of a prolonged and deeper downturn as we rip supply lines out and deepen uncertainty about investment and consumption and so forth. It also raises the risk of military conflict. Also, remember, the hopes for the electric vehicle revolution lie largely in China. And I think a lot of the folks who would like to see electric vehicles proliferate very fast, they do not want to see a break with China. China was consuming, buying, and producing most of the electric vehicles and controlled many of the critical minerals for that. So a rupture between the United States and China would be a setback for the electric vehicle revolution as well. So a lot of tectonic plates underneath global economy, politics, and geopolitics are shifting. Some we can see, but their impacts aren't so clear, like the debt. Others are still unfolding before us with really, you struggle for the word, but the US-China rivalry is going to be a real challenge for all of us to analyze and to live with going forward. Sweeping implications for the global economy, energy, and geopolitics.
And indeed, everybody around the world actually has to keep an eye on that and the implications. Talk to me, though, about peak demand. And this is something that comes up probably every decade. And I'm sure you've covered it over the years and you've written about it in detail. Has this pandemic actually, brought peak demand closer? And I know you talk a lot about boom and bust, that boom follows bust. Give me sort of your, to close on this one, your impression in terms of where do we go from here? And are we staring peak demand in the face right now?
Yeah. So, in the old days, we would argue about peak supply, but recently it's been peak demand. And the consensus going into the COVID pandemic was that we are approaching, in a decade or decade and a half or so, a global peak. Specifically, though, in the OECD, transportation fuel demand would peak and collapse early in this decade. If you look at the gasoline forecasts for the United States, OECD, by EIA, IE, and others, it's not only a peak, Etna, it's a collapse driven by policy, driven by electric vehicles and fuel efficient conventional cars. Etna, we were always skeptical about that here at Rapidan Energy Group. We doubted that policymakers had the will, had the money to drive that pace of decarbonization. Eventually, we will decarbonize. Eventually, we will find something else than oil to run our transportation system on. But near term, we thought the peak demand estimates consensus was wrong going into the pandemic. Coming out of the pandemic, we're even more convinced that peak demand is going to be a ways off. You're already seeing many articles and discussion about how the electric vehicles are going to be harder to sell after this. Folks are going to be poorer. Economic growth will be lower. Investment will be lower. Gasoline prices are much lower. Fuel prices are lower. Right now, low fuel prices don't help much when you're not allowed to go outside your house. But pretty soon, economic activity will pick up amidst low oil prices. So, in a way, a bust in oil sows the seeds of the next boom by encouraging demand for gasoline, transportation, distillate fuels. Petrochemicals, we're also optimistic on. If economic activity resumes, car making resumes, we're going to need more plastic bags and plastic items and stuff like that for sanitation. So we are actually optimistic about diesel, gasoline, petrochemical demand. Jet fuel will be hit, 8% of global oil demand. That's going to take a while to get back. I don't, unfortunately, plan to be doing a lot of business travel in the next year or two, unfortunately, and I think a lot of folks in my situation, our situations are the same. But everything else, the other components of demand will come back. So no, and meanwhile, officials, I think, are going to be less willing to impose the costs and the mandates that would be necessary to get sort of folks off of oil and onto electric vehicles. So I think it's going to delay the electric vehicle sort of driven peak demand even more.
Well, thank you so much for putting that all in perspective, Bob. And as you say, too, I think here and now everybody is caught in sort of the eye of the tornado, the eye of the storm in terms of what's going on at the moment, and everybody really has to just look after that. But again, I think people do need to, and governments need to be looking a little bit further ahead too, because we've got many, many more years that have to be taken care of, and that policy structure, even though they're very distracted at the moment, I think, would you agree, they really need to also be looking ahead and making sure they've got their eye on the prize down the road, so to speak.
Agreed, Etna. Couldn't agree more. It's going to be a challenging time going forward.
But anyway, you'll be keeping an eye on it, and it'll keep you busy and keep us all busy. And we look forward to talking to you again. Bob, I really want to thank you so much for joining me. Bob McNally, of course, from Rapidan Energy Group, and of course to all of you joining us for this ADIPEC Energy Dialogues. I really want to thank you so much. This, of course, is all in the run-up to ADIPEC 2020. We hope we're going to see everybody in Abu Dhabi in November. We're still looking at that. So from myself, Etna Trainer here, and all of the team, please, I just want to thank everyone for joining us. Stay in touch and stay with us with ADIPEC Energy Dialogues. Once again, thanks, Bob.
Thank you, Etna. Take care.